Thanks for clicking! Cracks are once again starting to emerge in Canada's financial system, with the central bank having to inject $12 billion into the repo market, the first such injection since March of this year. Yeah, and while there is a fair amount of disagreement as to exactly why these cracks are emerging, with CIBC continuing to insist that banks are hoarding money, some banks having lots of money and some having very little, what is clear is that the central bank is likely to restart its purchases of government bonds in short order. Not necessarily quantitative easing, but not necessarily laissez-faire either.
The cause of and solution to.
So what I want to do today is go over these cash injections, take a look at what it means for Canadians and for central bank credibility, and then go over some implications. As we'll see today, questions remain as to why the Bank of Canada is having to intervene into the repo market, and hopefully we'll get some answers to that at the bank's press conference held next Wednesday, and we'll obviously have an update out on that conference on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into these cash injections. On to the cash injections. Very briefly, let's go over the repo market. At the end of the day, every day, banks amongst each other trade back and forth cash and collateral. Bank A could be low on cash but have a lot of collateral on hand, like Government of Canada bonds, so it will go to Bank B and say, hey, can you lend me that money? I'll put up these Government of Canada bonds as collateral. Bank A gets the cash it needs to run its day-to-day operations, and Bank B gets some safe loans out there and makes a decent return every single day. Unless, that is, Bank B tries to charge Bank A higher interest rate than the rate set by the Bank of Canada, at which time Governor Macklem steps in, lending money to Bank A at the rate the central bank wants. Up until January of 2024, central bank intervention, these types of cash injections had been fairly rare as the banks were flush with cash, the money printed up for them by the Bank of Canada during the pandemic. And then the central bank did have to start to intervene here and there, and then really up until January of this year, central bank intervention had been a fairly common occurrence. Then something changed at the end of January when intervention slowed right down. And that change was the central bank lowering its deposit rate to 2.95%, 5 basis points below its target rate. And the reason why that matters is that the deposit rate is the rate that the central bank pays to the other banks for keeping their cash at the central bank. So, because the banks were being paid so much money from the Bank of Canada for holding their printed money at the Bank of Canada, they didn't want to lend it to one another. Lending money to the money printer, as ludicrous as that sounds, and indeed it is less risky than even lending it to another bank, as the money printer can literally print money. They're going to make good on their debts. But the central bank lowering the deposit rate, lowering the interest that it pays to those banks to 5 basis points less than the overnight rate, means banks were now financially incentivized to loan money to one another, even if it was only by 5 basis points. 0.05%. The funny thing, or not, at the time when this measure fixed the repo market, stopped the cash injections, was that the central bank was blaming all of these cash injections on hedge fund borrowing, when in actuality all the central bank had to do was stop paying such high interest on printed money held at the Bank of Canada, and then central bank intervention basically stopped.
I just don't like you no more.
But it's back now, as CORRA, the average overnight rate paid by banks amongst each other, has been consistently coming in higher than the bank's overnight rate, meaning banks are once again charging each other more money overnight than the central bank is hoping for. CIBC, which had been arguing in 2024 that those repo interventions were due to some banks hoarding cash, says that once again banks are being stingy with the money, with Ian Pollock noting that the underlying issue with Canadian reserves is there remain have-lots and have very little. So the idea is that some banks have a lot of money at the Bank of Canada, some banks have very little, and those banks that have a lot are being stingy with it and won't lend it at the rate being outlined by the Bank of Canada.
It's not fair.
And there is some support for this hoarding thesis, as even demonstrated in the paper where the bank blames hedge funds for their cash injections. The top 3 banks do have the majority of the cash on hand. So, a lack of overall funds available. Of the funds that are available, it's concentrated within about 3 banks. But, says RBC, the central bank is likely going to be riding to the rescue soon, saying that given the market disruptions and pop higher in CORRA, we do think the BOC will start bill purchases relatively soon. And by those bond purchases, RBC means that once again the Bank of Canada will be buying up government bonds from the banks. Now, this isn't technically a new development. The bank announced back in January that it did plan to turn the printer back on at some point, noting that it will be buying up bonds in the secondary market, meaning buying up government bonds from the banks. So CIBC loans the government money, the government gives CIBC a bond in return, then the Bank of Canada comes along, buys that bond up from CIBC. CIBC now has more money.
I am the smart. I am the smart.
Now, here's the key part. The central bank has stressed that it wants to limit the market impact of these purchases and that it won't be necessarily buying up bonds at any price. What this means is that the central bank doesn't plan to buy enough bonds at a high enough price to send yields, to send mortgage rates to the floor, but it also knows that this is really just a guiding principle. So we're not talking quantitative easing. The bank isn't committing to buying X amount of bonds every week, which will have a material impact on the market. But this is an additional player in the market for government bonds, which could, and probably will, help to keep a lid on prices, meaning that will help to keep a lid on yields, which helps to push down fixed mortgage rates and lowers the cost of borrowing for the government. Now, the Bank of Canada can, will, and has said that these purchases are just normal course asset purchases. But these normal course asset purchases will include the central bank using printed money to buy up older Government of Canada bonds, and also comes at the same time that the supply of new Government of Canada bonds are going to be hitting record levels. So let's put all of these coincidences together. At a time when the banks don't have enough money to lend to each other to fulfill their overnight obligations, that's coming at the exact same time that the government is going to be needing to borrow an awful lot of money. And now the central bank is coming to the market to do something normal and buy up a lot of that older government debt.
SMART.
What does all of this mean? Well, as we mentioned before, banks are going to have a lot more liquidity on hand, and when there's an abundance of something, the supply of it is cheaper, which means that should help to keep a lid on government borrowing costs and keep a lid on interest rates, which will help to keep a lid on mortgage rates.
Something just came across my desk, John.
On the other hand, that's liquidity that's being created by the Bank of Canada, and that liquidity helps keep down government borrowing costs. It lets the government borrow on the cheap, facilitating more government intervention into the market. But as the central banks continue to loosen the purse strings, which we're seeing both in the United States and increasingly here in Canada, that's just something to keep an eye on. It's not a problem for now, but definitely something to keep in mind as time goes on. 2022 wasn't a problem in 2020, an entirely foreseeable one, though it may have been.
Nothing's happening. Or will ever happen.
As the Bank of Canada continues to cut, as the economy continues to worsen, there will be, quite rightly, more and more pressure for borrowers to take on variable rate mortgages. And there's a good chance they'll do quite well on it in the short term. Keep an eye on that inflation rate, keep an eye on the money supply, keep an eye on Government of Canada bond yields, as the market will tell us where fixed rates are heading, and if you do need to lock in, that's where the signal is going to be to tell you to do so. And we'll also obviously continue to track it on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.